Hey, what's going on? This is Leo. So the FOMC meeting happened yesterday. Nothing was really too much of a surprise. Fed came out saying that they're going to raise interest rates by 75 basis points. So basically 0.75%. If we go over to the chart here, you can see that the market initially rallied on that news. And the reason it rallied is because the markets like to meet expectations. You know, if they're expecting 75 basis points to be the increase and that happens, it's kind of like a sigh of relief. He didn't go 100 basis points. We're okay. Everything is aligned with what we were expecting. And so then we saw this big sell-off. So what happened here? Why did the market get a little scared? Well, that's because Jerome Powell thinks that the terminal rate, meaning how much more we're going to have to end up raising rates, is going to be higher than previously thought due to new incoming data. Essentially, what they're saying is that they think the terminal rate's going to be closer to 475 basis points to 500 basis points, meaning that basically 5% being the federal funds rate. He did hint at slowing the rate of increases. So going forward, it kind of goes into the last video where we talked about most likely right now it's priced in 60% chance that we're going to see a 50 basis point increase. So 0.5% at the December meeting as opposed to 75 basis points, which what we've been seeing. So this is going to be the start of his pivot, right? So in my opinion, the pivot's going to come in three phases, right? So you're going to see a slowing at the rate of increase. So going from 75 to 50 basis points down to 25, then they're going to hold at whatever the terminal interest rate is. And then after they hold for a period of time, they're going to cut. So that's kind of what we're looking at. So we're going into the first phase of the pivot, in my opinion. Now, Jerome Powell did address some of the concerns that other economists and investors such as CEO Cathie Wood of ARK Invest have, which is, what if you're going too fast? What if, because this is a historic rate increases. I mean, we haven't seen this in a very long time, especially this how quickly he has been increasing. So essentially their concern is that, well, hey, what happens if you over tighten? What happens if this goes, you kill inflation, but we go deflationary? So first I want to define what inflation is, right? So inflation is simply the cost of goods and services increasing, and deflation is the cost of goods and services decreasing. So the Federal Reserve, they want deflation to an extent. They want to deflate inflation down so that we maintain their target rate of 2% inflation. So they do want it, right? But what happens if they go below their 200 or their 2% target, right? So what happens if we go negative 5%, where asset prices and stocks and everything, basically, it's the opposite of inflation at that point, right? So you're going negative. Asset prices, costs of goods and services, incomes, everything is decreasing. So that's kind of basically where you're moving into a recession, which is, that's the natural progression. If you move into a recession, you're going to see some deflation. That's just how it is. Home prices drop. Unemployment goes up. These are all things that the Fed is wanting to do. And so Jerome Powell went on to say that, if that does happen, then we will have the ability to fight deflation. It's easier for the Fed to fight deflation than it is for it to fight inflation. Once prices go up, they tend to be sticky, and it's hard to bring prices down. In the last video, I talked about an example. If you're running a lawn service business and you raise your if you go from $40 to mow a lawn to $50, are you really going to want to come down to $40 again? It's just not something you want to do. It's hard. It's harder to bring prices back down than it is to bring them up. So what would that look like? If we do, let's say that Cathie Wood is right and we get into a severely deflationary economy. Well, stimulus. Right? So stimulus is what brought on inflation to begin with, right? Whenever you have excess money supply within an economy, prices go up because now people have more money to pay more for things that they want, right? So the solution to a deflationary economy is just to pump a bunch of money in and cut interest rates, and deflation goes away as the economy begins to expand again. So inflation is a much bigger risk than deflation to the economy. And the reason for that is, let's say that you are going into retirement, right? And just for simplicity, let's say you have $100,000 saved. I know that's nowhere near what you would need to be able to, well, let's say $1 million, right? So you have $1 million moving into a retirement, and inflation is at 10% a year. Well, 1 year into your retirement, you have lost $100,000 because the cost of goods and services have gone up by 10%. So your $1 million now only buys $900,000 worth of goods. You still have your $1 million, but because the cost of goods and services has gone up by 10%, you really don't have that much. So it becomes a huge threat to the economy. It becomes a huge threat to, I think it's something like 30% of baby boomers they're going into their retirement, and that's a big number. 30% of our population, if their retirement starts getting whittled away by inflation, that's a big deal. That's a bigger threat to the economy than deflationary asset prices temporarily. So I think that's where the Fed's mindset is. They want to get this thing under control to a certain degree. I still think that the Fed wants some amount of higher inflation for some time, just because we have a huge debt problem going on. And historically, the way that countries deal with excessive debt to their GDP is they inflate it away. They allow inflation to be high, whatever it may be, 5%, 4%, 10, 15%, whatever it may be. But they inflate it away, right? So because it's relative to your GDP. If your debt is $1 trillion, but your economy is a $10 trillion economy, it's not so big of a deal. But if you have $1 trillion debt and your economy is a $10 million economy, well, now you kind of screwed the pooch on that one. I mean, you're in a lot of trouble there. So the solution to the government in that situation is to simply inflate it away. On a more positive note, he being Jerome Powell, he did acknowledge that they are going to take a look at more leading indicators, since inflation is a lagging indicator of kind of what's going on within the economy. So that is kind of more dovish talk, a little bit more of a hinting that the pivot is coming, right? And so people define the pivot in different ways. I've already told you that I define the pivot as a stages, right? So it's a slowing of the increase, a pause of the increase, and then we finally cut. Some people only consider the pivot being whenever you finally cut the rates. I don't look at it that way, but because the way the economy works now is that, as opposed to how it did 40 years ago, is that information moves so fast that the market will anticipate what is coming. So what do I mean by that? Well, as the Fed begins to slow the rate of increases, they are anticipating that we are closer to the end of the recession than we are at the beginning. And so they will begin to price in the pivot before it happens, if that makes sense. So I think that pretty much wraps this up. There's not a whole lot else to talk about. So until next time, I'll talk to y'all soon.